Hey, Stephen Nance here from DrillDown Solution. It's good to be with you. I want to talk to you about 6 steps to avoid the tax man. I actually started my career as a CPA on the other side, as an auditor for the Utah State Tax Commission. If the IRS does make an assessment to where you owe tax, not only do you have to owe the tax and pay the tax, but there's typically a 20% penalty that's added on top of that, plus interest. So it really does pay to avoid things that are going to be high risk and do your taxes right the first time. So I'm going to go over these 6 simple steps that will help you kind of be prepared and avoid this situation. So first of all, avoid anything that's going to be high risk or a low-hanging fruit, anything that's going to put a target on your back. You want to avoid. An example of that is S-Corp officer wages. So if you have an S-Corp and you have no officer wages, or your officer wages are low compared to how much income overall is running through that S-Corp, that's a potential target you have on your back. You actually have a really good chance of being audited. That is what the IRS is pooling audits for. And once they pool you for audit, they can open it up to see anything. And so you just want to avoid that low-hanging fruit for the IRS. Number 2, if you do take a high-risk position, make sure there's a good legal justification for it. So a legal justification is not you have a low probability of being audited. A legal justification is something that your CPA can defend you if you are audited. And in some cases, you may even want to get an attorney involved so that you have a team willing to back you up. Also, if you are taking a high-risk position, it's a good idea to make sure that everything else on your return is very clean, squeaky clean, so that when you do get audited, you can focus, or your CPA can focus on defending that big issue, that one big issue, instead of getting lost in the mud of all these little ticky-tack things that are really going to make you look bad if the IRS is auditing you. Number 3, keep receipts. Nowadays, fortunately, there are a lot of apps that can scan your receipts and organize them for you, and you can just Google apps for keeping receipts and you can find something that works for you. But the IRS does require you to keep receipts. A bank statement is typically not good enough. There's typically more information on an actual receipt, a little bit more information, not much, than what would appear on a single line item on a statement. So, and you're actually required to have the receipt to even claim the deduction. That's the technical rule. So make sure you keep receipts. And also, when you have a transaction, say for example, it's a receipt for a restaurant and you're claiming a business meal expense, you need an actual description of the business purpose of that. So if you are going out to lunch with your business partner, or even with someone else, a potential customer, you need to be able to have a description somewhere written down that describes what that business purpose was. You took this potential customer, you were trying to win their business, or you were traveling for business purposes. So it was a business-related meal. Eating by yourself during the workday or with a business partner is not going to cut it on its own. So there needs to be a description of what that expense was and why it's business-related. So number 4 is have good accounting. The most common accounting software is QuickBooks for small and mid-sized businesses in the U.S. It doesn't have to be QuickBooks, but the IRS auditor typically, or there's a good chance, will want some form of access to your accounting software, so they can go in and see how transactions are being recorded. If you're applying some consistent accounting procedures that are being followed, and it's clean, basically, is what they want to see. Number 5, avoid commingling of personal transactions. This is a big one that does happen if the IRS sees that you've got a lot of personal expenses mixed in with your business expenses. The IRS assumption is that everything's personal, and they're going to disallow everything unless you prove otherwise. And you don't want to be backed into that corner. And finally, number 6, avoid commingling with other businesses. If you have multiple entities that you have ownership in, sometimes you might have to more or less subsidize one business with the other or move money back and forth, and that's okay. You just need to be able to record the transaction on both sides the same consistently. And if not, things get messy. Income is typically over or under reported, and you don't want the IRS to come in and say, well, I can't figure this out, I'm just going to disallow everything. So I think these 6 simple steps you can find helpful as you plan and navigate your taxes. If you find this helpful, go ahead and like or share this video, or feel free to post in the comments something that you liked and was a key takeaway for you. Again, Steve and Nance, good to be with you, and look forward to talking to you again later.